Hey everyone, it's Zack Beck. The CARES Act was passed back in March of 2020 and it allowed individuals to take up to $100,000 out of a qualified retirement account without incurring the normal 10% penalty if they were to do so before the age of 59 and a half. Now, many individuals took advantage of this new situation, and unfortunately 69% of those people say that they are not going to be able to repay their 401k or their IRA account, and instead they're going to have to pay taxes on this distribution over the course of 3 years. And because the CARES Act allows you to spread this over the course of 3 years, you have the advantage of being able to do so over time, but it's important for you to be aware of that you need to at least declare up to 1/3 of that distribution in your 2020 tax filing. So what I want to do in this video is break down in detail how to file your taxes properly when it comes to an early distribution due to the CARES Act, and more importantly, the specific steps you and I need to take in order to move forward to achieve our long-term financial goals. So let's take our time, dive into the details, and jump into it right now. As previously mentioned, the CARES Act allows individuals to take up to $100,000 out of a qualified retirement account without incurring a 10% penalty. Now, there are many individuals who decided to do this, and nearly 69% of those people said they are not going to be able to repay this fully into their account. Therefore, they're going to pay taxes on this distribution over the course of 3 years. Now, 18% of people in the same survey said that they plan to repay part of this distribution, and another 13% say that they plan to pay the entirety of the distribution back into their retirement account. Now, depending upon where you fall in the situation, it's important for you to understand the tax implications associated with this, because you don't want to be hit hard by the IRS because you might already be encountering a difficult time that required you to make that early distribution in the first place. The most important thing for you to be aware of if you actually took an early distribution out of your 401k, your IRA, or other qualified retirement account due to the CARES Act is that you need to declare at least 1/3 of the income that you received on your 2020 tax filing. Otherwise, you might encounter some significant issues with the IRS. As previously mentioned, you have up to 3 years to actually pay the course of your taxes on the early distribution that you took, but then you need to make sure that you're including at least 1/3 of it here in 2020. So let's say, for example, that you took $9,000 out of your retirement account early during the course of 2020. What you need to do then is you need to make sure that you at least declare up to $3,000 in your income associated with that distribution on your 2020 tax return, and then pay the taxes on that accordingly. Now, it's important for you to be aware of that the CARES Act only waived the early penalty associated with that. It did not waive the taxes. So you're not paying the penalty when you pay this in the upcoming tax filing season. You're just going to be paying the taxes on the distribution. And depending upon the specific tax form that you receive, you might have to take additional steps to make sure you're filing your taxes properly. And that's because probably the most challenging thing associated with this early distribution is how it was actually reported. And what you want to make sure is that it was reported properly, so that way you can actually just go ahead and follow the steps accordingly to make sure your taxes are done in accordance with IRS law, but also you want to make sure that you don't incur another penalty from them, because that could just eat away at the reason why you actually took out the money in the first place. An important thing to be aware of when it came to making that early distribution is you had to have a qualified reason for doing so, such as having a direct illness associated with the pandemic, or maybe your spouse was affected by the pandemic, your job and your income was affected by the pandemic. So there's a lot of elements associated with this that allowed individuals to qualify to make this early distribution. It is also important to note that this distribution allowance did not carry over into 2021. It was often talked about that the new administration might allow individuals to carry over and actually continue to make these early distributions in 2021, but that never came to fruition. So this expired on December 31st, 2020. So this only applies if you made the early distribution during the course of that year. And if you did it in 2021, unfortunately, you're going to actually have to pay the penalty on that unless you had another reason that you could have done so. I actually made a completely separate video that talks about other ways that you can currently withdraw from your 401k account without any sort of penalties associated with that if you have qualified reasons for doing so. Feel free to check that out if you like, and that should enable you to do so if you're still encountering problems right now. When it comes to the rules associated with this early distribution, it's important to be aware of what kind of retirement account you operate with. And if you took money out of a traditional account, such as a traditional IRA or a 401k, it's important for you to be aware of that when you're actually making a contribution into that account, you're doing so tax-free. You don't pay taxes until you actually withdraw the money. This is very different in comparison to a Roth account. So if you have a Roth IRA or a Roth 401k, this is very different, because what you do with a Roth is you're actually paying the taxes at the front end, and you don't pay taxes when you bring the money out of your account later on, as compared with a traditional account where you pay taxes afterward. So generally speaking, if you're in a higher income tax bracket right now, that's a benefit of using a traditional 401k or a traditional IRA, because you're anticipating when you take the money out at a later time, you'll be in a lower tax bracket. The opposite is true. So if you're in a low tax bracket now and you anticipate being in a higher tax bracket later in life, that's when a Roth account can be beneficial for you. Now that's just something for you to be aware of, but if you took money out of a traditional 401k or a traditional IRA or other qualified retirement account such as a 457 or a 403b, you will find that when you're taking the money out of your account, you still need to pay taxes on that as though it was income. And you basically just include that income as part of your adjusted gross income when you're actually filing your taxes, and that will raise you to potentially a higher tax bracket, so you might be paying a higher percentage on that. Now, once again, I am just a guy on YouTube. I do not have all the answers to this, but it's important for you to be aware of, and that's why I just want to share this with you, because I don't want you to find yourself in a situation where you lose more money after making this withdrawal that was done in more of an emergency situation. So it's important for you to be aware that if you took an early withdrawal, you need to declare that in this upcoming tax filing season, and the deadline is May 17th, 2021 for you to file your tax returns, unless you file an amended form that you actually wanted to delay this until October 15th of 2021, which is a possibility as well. So all that being said, it's important for you to be aware of that you're paying the taxes on the withdrawal. You're not paying a penalty associated with the withdrawal. When it comes to paying taxes on the early withdrawal, like I said before, you have 3 years to do so, and you need to declare at least 1/3 of that during the course of your 2020 tax filing. So back to my previous example, if you took $9,000 out of your retirement account, you need to declare at least $3,000 on your income taxes this tax year, and then you need to do the same in the following 2 years, totaling $9,000. Now, one of the benefits associated with the CARES Act is they said that you're allowed to actually repay your account, and then you don't have to pay the taxes on this. So if you anticipate that you're going to actually repay the account in the future, you want to make sure that you're aware of how to actually account for this in the future, because you will need to file amended tax returns to basically recoup that on a future date. So it doesn't mean that if you plan on repaying it that you're able to not pay the taxes right now unless you've fully repaid your account already. If you're going to take the next 3 years to actually repay your account, you're still going to need to file taxes every single year, and then you will recoup those taxes that you paid at a later date. One of the most effective ways to navigate the tax situation associated with the early distribution from the CARES Act is if you tax the like button for the YouTube algorithm. I'm just kidding, but if you wouldn't mind, please hit the like button for the YouTube algorithm. Help push this video to other people who need to hear it so they can file their taxes properly and make sure they're moving on towards a positive path for their own wealth development. When it comes to the specific forms that you will need to file with your taxes this upcoming year, you should have received a 1099-R, and that form would have been sent to you declaring how much money you withdrew from your retirement account. On the form itself, there should be a distribution code in box 7. If the code listed is a number 2, it signifies that the amount you received in 2020 from your plan was for a qualified reason under the CARES Act. And one thing you need to be aware of, if there is a 1 in the code box, you will need to fill out a form 8915-E to certify that your distribution should qualify under the CARES Act. And this is important for you to be aware of, because if for some reason the IRS did not have a qualified reason for you actually making that withdrawal, you will be dinged with that 10% penalty, which could be very significant depending upon how much money you took out, and also really eats away at any of the prior gains that you had in the market when you had your money sitting in that account. So it's really important for you to make sure that when you're getting that form 1099-R, that the number 2 is in box 7, so that way you're making sure that you're only going to be paying the taxes on this, not the taxes plus the penalty. Because on the form itself, it's going to ask what the distribution actually was for. When it comes to the form 8915-E, that is generally used for disaster-related distribution and allows you to report the early withdrawal over the course of 3 years. And it's also worth noting that there's a chance that the use of this form could actually pique the interest of the IRS, maybe causing an audit. So you just want to be very mindful of how you do this. Obviously, you just want to be honest and truthful and trustworthy when you're going ahead and filing your taxes, but you don't want to do something that's going to put you in a precarious position unnecessarily. And if that does happen, basically you will probably just engage in a correspondence with the IRS where they will ask you why you qualified for this distribution. So don't ever expect to receive an email from the IRS or a phone call. Generally, it's going to be physical letters sent back and forth. And because of the delays that's been occurring recently with the IRS just processing mail because of the pandemic and people working from home at the IRS itself, this could take a while. So just try and do everything you can to get everything filed properly so that way you're not finding yourself in this years-long correspondence back back and forth with the IRS. You just want to make sure that you can get this done properly the first time. An important thing to be aware of is that the CARES Act eliminated the required minimum distribution in 2020 and allowed individuals who took a required minimum distribution in the early portions of 2020 to have that reversed. And for those who might not be aware of what a required minimum distribution is for individuals over the age of 72, they're required to start withdrawing out of their retirement account a set amount. And so this is a very important thing to be aware of, because if you had to do so when you're over the age of 72, you might be able to have this qualify for you, so that way it is seen as a CARES Act distribution as opposed to a required minimum distribution, which could affect your tax implications. And that's why it's important that if you did take a required minimum distribution and did not have it reversed, you still have the option here in 2021 to see if it could qualify under the CARES Act, and then you would actually only have to pay taxes on that over the course of 3 years. Additionally, just like the CARES Act 401k early distribution did not carry over into 2021, neither did the required minimum distribution elimination. So this is very important that a lot of these apply to what happened in the tax year of 2020, but you're still filing the taxes here in 2021. So I just want to make sure you get it done properly so you're on the road to success. Now, one thing I really want to stress is that I'm very sorry if you actually had to take an early distribution from your retirement account due to the pandemic. Perhaps you lost your job, you suffered an illness, you had to deal with the stress and anxiety associated with what was going on in the world, and then you had to take this money out that you'd been saving for years, hopefully to allow you to have retirement in the future. And if you had to do so, I am very sorry. What I want to encourage you in is that if you have the ability to actually repay your account, obviously 69% of people said they do not, and that is very unfortunate. But if you're able to make some modifications and changes in your life so you can get that money back to work for you for your retirement in the future, I would strongly encourage you to do so. Obviously not putting yourself in a dire situation. You obviously need a roof over your head and food on the table, and you need to have lights on, you need to have transportation to and from where you're going. So obviously you need to make sure those things are taken into consideration first, and then if you have the ability to actually move forward and start saving and investing for your future, I strongly encourage you to do so. And there are various avenues you can do, and that's, like I said before, try and repay your 401k or your traditional IRA or whatever retirement account you made the early withdrawal from. And then furthermore, if you're able to continue to augment the amount of money that you save and invest for your long-term future, it will benefit you tremendously. I know there might be people watching this video right now who may be in their teens or 20s, not really thinking that their retirement is that important, but I will tell you that when you're younger in age, it's so important for you to at least get the benefit of compound interest, so starting to invest early can really be a benefit for you. Furthermore, as you get into your 30s, 40s, 50s, and 60s, getting ahead of this when it comes to your retirement is essential, because you really want to make sure that you have a proper nest egg there so that you can retire with dignity and be able to fulfill your purpose, not only in the present right now, but even at the age of retirement. And one thing that you can do about this is to make sure that you have your system in place to make sure your finances are going accordingly. And I talk about this frequently, the importance of having an automated financial system. It's what I have in my life, because there was a period of time in my life where I did not have this in place, and my money would just go wherever the whims were, wherever my emotions took me. And unfortunately, that led me down a path towards debt. It led me down a path where I did not invest my money, and then it put me in a financial position where I had more stress, anxiety, and I wasn't preparing myself for the future, and it really put me in a more stressful situation in the present. So if you can make sure that you have a system in place where you have money automatically coming out of your paycheck and going into a retirement account, such as a 401k, a 457 if you work in government, or a 403b if you're an educator, and if you can do that right off the top, that is great. If you prefer not to do the traditional route, obviously you have the Roth alternatives, which you can do either as an alternative to a 401k, or what I like to do is in addition to my normal 401k account. And if you do that, that will allow you to augment your savings rate and continue to move forward as you go towards retirement. Furthermore, you want to make sure that you have other money going and paying off all of your debt. Hopefully you can work towards being debt-free. If you're on the pathway and want to get there, I'd strongly encourage you to check out Dave Ramsey's debt snowball method, basically where you pay off your lowest balance debt first and then work your way off to pay off your highest balance debt. That's a great approach to take. And then make sure that all of your bills are automated. Maybe do an audit internally and look at how many subscriptions you have, what areas you could cut back on spending, because if you can cut spending, save money, avoid lifestyle inflation, avoid debt, and then begin investing into the stock market, preferably into index funds, which are easy to understand index funds that allow you to basically track the performance of the stock market without having to pick a Tesla or a GameStop or an AMC or trying to find the hottest stock of the moment, just kind of allowing yourself to go long-term with a more passive approach. I think that's going to position yourself in a great situation where you can benefit That's what I do for myself, and it has made a dramatic change in my life. So I just want to have more people experience that as well, so that you can be more mindful in the present and fulfill your purpose in your life, so that way you're not always thinking about money, because money is just a vehicle and a tool for us to use in the world. It shouldn't be our primary dominant focus. And generally it's a dominant focus from a negative perspective, not a positive perspective. And I want you to move forward towards having a positive net worth as opposed to a negative net worth. So we want to shift our focus and head in that direction. Now, if you actually want to get started in investing and you want to open up, say, a Roth IRA account, you can do so through various avenues. Personally, I like to use Wealthfront. That's where I do the majority of my investing. It's investing primarily into ETFs that are index funds that are passive and very simple to use. And what you do is basically you fill out a form that completes what your risk tolerance is. So that way, if you're someone who's willing to take a bit more risk, it will adjust your portfolio accordingly. If you're more risk averse, it will adjust it to be a bit more balanced with more bonds. So one thing you can do is if you like, I have a link in the description for you to check it out, and you can go ahead and start doing this with Wealthfront. Furthermore, if you want to go the more individual stock route, you could choose something like a Robinhood or a WeBull, and I have links in the description for those if you want to go and pick and choose individual stocks. Now, my apprehension with having that be the primary focus for you is that study after study continues to demonstrate that index funds outperform individuals who are trying to pick and choose stocks. So if you're like the average person like myself, generally going with a more index fund approach is probably going to be a safer and more solid return than if you're trying to pick and choose individual stocks, especially when you're thinking long term. Just something that you can do, but if you want to go ahead and get some free stocks, feel free to click the link for Robinhood and click the link as well for WeBull. You can get a stock worth up to $1,400 when you deposit $100 on the platform. And if you start getting in this habit of saving and investing, it'll be something that really positions you effectively so you can achieve your long-term goals. With all that being said, I'd like to thank you for watching the video today. If you wouldn't mind, please tap the like button for the YouTube algorithm. Help push this video to other people who might need to hear it. Furthermore, if you wouldn't mind, please comment down below. I'd love to interact with you, get to know you, do any research on your behalf, and help you make well and wise formed decisions right now in the present so you can achieve your goals in the future. Furthermore, if you wouldn't mind, please subscribe to the channel. That would mean a lot to myself personally. Help push this video to other people who might need to hear it. Furthermore, if you wouldn't mind, please tap the notification bell. That will notify people anytime I post a video, which I do on a weekly basis. And one of the things I really want to stress is that I try and create videos here to make a positive impact in your life, to encourage you and myself to lead lives of meaning and purpose, all while maintaining balance and moderation. So I hope this encourages you to do that. I hope that you're able to achieve your long-term goals, and I'm here for you, and I love you guys. So I hope you have a great day, and I look forward to talking next time. Have a good one.